Good Monday morning, and welcome to SPSI Inaugural Weekly Market Analysis Podcast. I'm Kerrigan Vale, and joining me this morning is one of our market strategists, Hale Mercer. Hale, we're broadcasting this just before market open on Monday, August 18th. And honestly, what a week to launch this show.
Good morning, and thanks for having me, Kerrigan. You're absolutely right. We got some fascinating market dynamics to unpack. Our sentiment data is telling a compelling story about where money is rotating, and frankly, some of the signals we're seeing are setting up what could be a pivotal few weeks ahead.
Before we dive into the numbers, let's set the stage. For our listeners who might be new to sentiment analysis, can you give us the 30-second elevator pitch on why this matters?
Sure. Think of sentiment as the market's emotional barometer. We're not just looking at price movements, we're measuring the velocity and acceleration of how money flows between sectors. It's like having a GPS for market momentum. And right now that GPS is pointing toward some very clear sector rotation opportunities.
All right, let's start with the big picture. The week of August 11th saw mixed performance. Dow up modestly, S&P and NASDAQ pulling back slightly. But your sentiment data is telling a different story, isn't it?
Exactly. While the headlines focused on that mixed performance, our general sentiment indicator moved from 49.12 to 52.14 over the past 3 weeks, with velocity sitting at a healthy 3.03. That sustained upward momentum, even with Friday's profit taking.
In the volatility picture,
this is where it gets interesting. Both our VIX and MOVE indicators are flashing favor risk signals. Translation, the fear gauge is low, bond volatility is contained, and conditions are ripe for more aggressive positioning. It's like having a green light for risk-on strategies.
Now, I know our listeners love connecting the dots between macro and individual opportunities. Apple's $400 billion market cap gain after that Trump meeting. That's not just a news story, that's validation of your consumer discretionary momentum call, right?
Our consumer discretionary sector is showing velocity of 9.42. Apple's surge isn't happening in a vacuum. It's part of broader momentum we've been tracking. Though I will say we're seeing some deceleration at negative 4.12, which suggests we might be in the middle innings of this move rather than the early innings.
Speaking of connecting macro to micro, Bitcoin hitting $124,000, is that just crypto mania, or does it tie into your broader risk-on thesis?
It's absolutely consistent with our risk-on environment. When you have declining volatility measures and improving sentiment, speculative assets typically outperform. Bitcoin's move is really just the most visible manifestation of the favor risk signal we're getting from our volatility models.
Let's talk earnings. While we didn't have a massive earnings week, there were some standout movers. United Health surging 12% on that Berkshire position. That caught everyone's attention.
And it perfectly illustrates why we focus on sentiment acceleration, not just absolute levels. Healthcare as a sector sits at just 37.27 sentiment below average, but it's showing acceleration of 8.93. That's telling us money is starting to rotate into what's been an unloved sector.
That Berkshire stamp of approval carries weight.
Absolutely. When Warren Buffett puts $1.57 billion into United Health, institutional money pays attention. But here's what's really interesting. Our sentiment models were already picking up this rotation before the Berkshire news broke. That's the power of tracking money flows rather than just waiting for news catalysts.
Now, on the flip side, we had some earnings warnings. John Deere talking about $600 million in tariff costs. How does that fit into your sector analysis?
Great question. You'd think that would crush material sentiment, but we're actually seeing positive momentum there. Velocity of 4.02, acceleration of 1.61. The market seems to be looking through near-term tariff headwinds and focusing on longer-term infrastructure spending and reshoring trends.
Industrials is another area where you're seeing strength despite some mixed earnings narratives.
Right. Industrial sentiment at 58.91 with velocity of 3.65. That's consistent growth. But here's the kicker. Our transportation industry group within industrials is showing acceleration of 20.84. That's explosive momentum. Airlines, trucking companies, there's serious money rotating into transportation infrastructure plays.
And this ties back to your tariff thesis?
Exactly. If we're going to see more domestic production, someone has to move all those goods around. Transportation becomes a pick and shovel play on the reshoring theme.
All right, let's get specific. Our listeners want actionable ideas. You've identified 3 stocks that represent different strategies, 2 trend-confirming plays, and 1 contrarian bet. Let's start with Johnson & Johnson. That's your healthcare turnaround story.
J&J is fascinating because it represents everything we just discussed about healthcare's inflection point. Our DEF strategy, that's our defensive, quality-focused approach, shows a profit factor of 7.08 with a 75% win rate. Those are exceptional numbers.
Right. Walk me through the fundamental story here.
Indeed, healthcare sentiment at 37.27 has been depressed, largely due to regulatory overhang and pricing pressure concerns. But J&J is different. They're diversified across pharmaceuticals, medical devices, and consumer products. The acceleration we're seeing in healthcare sentiment suggests institutional money is rotating back into quality healthcare names that were oversold.
And the technical setup?
The 75% win rate tells you this isn't a coin flip. When our sentiment models flash by on quality healthcare names, they tend to work. The catalyst could be anything. Maybe Jackson Hole brings clarity on regulatory policy. Maybe we get better than expected earnings guidance, but the setup is there.
Second pick, Lattice Semiconductor. That's your semiconductor confirmation play.
LSCC is beautiful because we're getting dual signals. Both our aggressive and defensive strategies are flashing buy. Aggressive strategy shows a profit factor of 1.34. Defensive shows 6.98. That divergence actually tells us something important.
Which is?
The defensive strategy's massive outperformance suggests this isn't just momentum chasing. There's fundamental value here. Lattice operates in the analog and mixed signal space, less sexy than AI chips, but absolutely critical for everything from automotive to industrial automation.
And they benefit from the reshoring trend?
Exactly. Plus, remember that NVIDIA AMD revenue sharing deal with the US government, that's creating a more predictable regulatory environment for the entire semiconductor space. Companies like Lattice that serve domestic markets are getting re-rated higher.
Now for the contrarian play, Kinsale Capital Group. This one's a sell signal, which feels bold given the market environment.
This is where experience matters, Kerrigan. KNSL shows a SELL signal with a profit factor of 2.85 and 63% win rate. That's our aggressive strategy saying this insurance stock has gotten ahead of itself.
But insurance should benefit from rising rates, right?
That's the conventional wisdom, but our sentiment analysis on financials shows velocity of just 0.7, barely positive momentum. Within financials, the insurance industry group specifically shows velocity of negative 1.78. Money is rotating out of insurance, not into it.
What's the fundamental story there?
Insurance stocks have been priced for perfection based on the rate environment, but we're potentially heading into a Fed easing cycle, and insurance companies' investment income could take a hit. Plus, you've got increased catastrophe risk, regulatory pressure. There are headwinds people aren't talking about.
So this is a case where sentiment is ahead of fundamentals.
Precisely. When our models flash sell on a stock that's been a market darling, we pay attention. The 63% win rate says these signals tend to work even when they feel contrarian. Now, I should clarify, we're not in panic mode, oversold territory here. Many insurance companies have already retreated from their peaks, which actually represents a good opportunity for initial positions or adding small amounts to existing holdings, but KNSL specifically has held up too well relative to the sector rotation we're seeing.
So it's more about relative positioning than calling for a sector collapse.
Exactly. This isn't about insurance being a terrible sector. It's about individual names that haven't participated in the broader sector reset. Smart money might be rotating from the names that have held up best, like KNSL, into insurance companies that have already done the heavy lifting on the downside, or communication services at 4.44 velocity with positive acceleration.
And defensive?
Defensive is about quality and sustainability. Utilities at 79.82 sentiment, highest absolute level, even with zero velocity. That's your ballast. But defensive doesn't mean passive, that Johnson & Johnson call. That's defensive positioning in a turnaround story.
Looking ahead, Jackson Hole is obviously the big event. Markets are pricing in a 90% chance of a September rate cut. Your take?
That 90% probability feels way too high. Powell's going to stick to his data-dependent script. We've got another jobs report, several inflation readings before September. The market might be setting itself up for disappointment.
How does that impact your sector rotation thesis?
If Powell sounds less dovish than expected, you could see some of that momentum in rate-sensitive sectors reverse quickly. Real estate is already showing weakness, sentiment at 32.87 with negative acceleration of negative 5.5. A hawkish surprise could accelerate that decline.
And the tariff issue?
Sector-specific tariffs are the wild card, but our sentiment data suggests the market is already positioning for this. Materials showing positive momentum despite the John Deere warning, industrials remaining strong. The smart money is betting on domestic beneficiaries of trade policy shifts.
Bottom line for the week ahead?
Stay nimble. Our sentiment models suggest the underlying trends remain intact, but Jackson Hole could create short-term volatility. Use any weakness to add to quality positions in the momentum sectors we've identified.
Hale, this has been fantastic. Before we wrap, remind our listeners how they can access the full SPSI Pro analysis.
All the detailed data, individual stock signals, and sector breakdowns are available in our weekly tracker report. Our Substack address is spsi.substack.com. We'll include the link in the show notes and description below.
With that said, we'll be back next Monday with another deep dive into market sentiment and sector rotation opportunities. Thanks for joining us on our inaugural episode.
Thanks, Kerrigan. Looking forward to tracking how these themes develop.
This has been SPSI Pro's weekly market analysis. I'm Kerrigan Vale with Hale Mercer. Trade safe, and we'll see you next week. All investing involves the risk of loss, including potential loss of principal. This podcast is for informational and educational purposes only and should not be considered or regarded as personalized investment advice or relied upon for making investment decisions. Our analysis and opinions are based on historical data and market trends, but past performance doesn't guarantee future results. Please consult with a qualified financial advisor before making any investment decisions, and always do your own research.